Hey, this is Jeff Cameron with the Cameron team at HomeSmart, and it is August of 2013, and we've seen rates jump. You know, just a couple months ago, they were at 3.5%. Even below that, I know some people are locked in like below 3, 2.7. Anyway, it's different today, and it's going to continue to go up as the economy continues to get better, and we'll get back to a more normalized interest rate. Now, a lot of people don't know what a typical mortgage rate is made up of, and it's made up of two components. One is inflation, and the other is the return on the investment for a secure investment as a mortgage to the investor. So typically inflation runs at about 3.25%. They've been saying it's not non-existent. I think everything's more expensive, but whatever. So if we have inflation normally at say 3.25%, and if our investor wants a 3.5% return, then we're going to have 6.75. If they're 3.25, we're at 6.5. That's going to be a market-based thing. Right now, they're claiming rates are inflation is non-existent, and that's why we had just that 3.25, and now we're back up to about 1% inflation. 1.25 gets us up to that 4.5. So, how rates affect your monthly payment and what this does to people's affordability? I ran these numbers, and I thought it was really interesting that what I saw, and then I did this with a $250,000 mortgage, a $350,000 mortgage, $450,000 and $550,000. And then I did this with rates where they are today at like 4.5%, going up to 5.5% and 6.5%, looking at from today moving forward, because as the Fed moves out of buying mortgage-backed securities and bonds, the demand for those will go down and the rate will go up, and also we'll start to see inflation back in the measurement. So it was interesting to see $250,000 home at 4.5%, or did a 28% debt to income, and I did this is principal and interest only. But $1,267, all you need is a $54,000 income. Now, I just closed on a house last week, and the gal made $120,000, and the loan amount is $160,000. So I think our buyers have been really, really, really conservative, which is good, but that's just a fact. If rates go up to 5.5%, then that payment's going to go from the $1,267 to $1,419, and you need to make $61,000 for the entire family or household. Up to 6.5%, now we need $68,000. So you see the difference here, although it is $14,000, which is like 25%, it's not that much. This is total household income to afford a $250,000 mortgage amount. So let's go up to $450,000, and we'll have this whole graph right here. We'll go up to $450,000, and we see we have at 4.5% a $450,000 mortgage, $2,280 is the payment. You need $98,000 in total family income. At 5.5%, $2,555, and you need to make $110,000. And at 6.5%, you need to make $122,000. So again, I go to the $550,000, and we've got a $2,800 payment roughly, with $120,000 in income. The folks I'm selling homes and have a $550,000 mortgage make a hell of a lot more money than this. So their purchasing power is there, and they make a hell of a lot more money than that. So as rates go up, it's going to be an interesting thing we're going to see over the next year, because we have tight demand, but we also have interest rates going up, so that's going to affect purchasing power. It's how much does it? So is it affecting your purchasing power? Is it affecting the value of your home? Call me, Jeff Cameron, here at HomeSmart, the Cameron team, and I will help you get answers to all of that. You can reach me at 480-502-7699. Make it a wonderful day.